Excellent. Thank you everyone for attending our webinar today. We will give about 1 more minute for people to join, and then we will kick start with the content. We have a lot of audience today. It seems like everyone wants to learn about profit split versus transactional traditional methods. One thing that we are very happy about is the design. I find this design to be very catching. So while everyone finishes joining, a couple of points. We will go through the content today. We have a Q&A box where people can ask for questions, and then we can dedicate the last about 10 to 15 minutes to answer everyone's questions. So this is one of those topics of our series of new transfer pricing landscape, and the reason why we decided to share today this topic with you all is because with the new initiatives around tax, and particularly the possibility of a profit split apportionment implementation, it is good to have an understanding of what a profit split is versus what traditional transactional methods are, and what are the benefits and the challenges around using one approach versus the other approach. Before we enter into the detail, let me just give a brief overview of our firm for those who are new to our webinars. So essentially, our firm specializes in advising multinational companies in the area of transfer pricing. We are one of the probably only independent firm that still stands as of today to be an independent advisor on transfer pricing and international tax aspects associated with transfer pricing. We have 4 offices: Australia, Singapore, Malaysia, and UAE. And from there, we focus on clients in Asia, and even sometimes Europe and the Americas. We are also very proud of being considered Tier 2 firm. We contribute a lot when it comes to the education and opinions and articles in different journals, now in our own YouTube channels, and many, many other places that you probably have come across to our firm, basically. So today, for those who are not familiar, we have Hon Chuan Tan and myself going through some of the aspects of the presentation for today. Hon Chuan is one of our directors and technical lead in Malaysia with more than 10 years of experience in transfer pricing and indirect tax. He has played a very key role in pioneering and developing our transfer pricing practice prior to that with another mid-tier firm. And he is crazy enough also to be practicing transfer pricing for more than 10 years, isn't it, Hon Chuan?
I mean, we all
have thought advising clients in all aspects of transfer pricing, documentation, planning, country-by-country reporting, effective tax supply chain management in the Asia-Pacific region across multiple industries. I think between Hon Chuan and myself, we probably have covered any type of transaction that a multinational group enters into. So feel free to ask any questions. And myself, Adriana Calderon, I'm the technical lead for Asia and director, co-founder of Transfer Pricing Solutions Asia and Malaysia, with more than 15 years of experience in the area of international tax, transfer pricing across South America, US, Australia, and the Asia-Pacific region. So with that, maybe we can kickstart with our topic for today. which is transfer pricing methods. And we will basically first start with giving a brief overview on both type of methods and give some examples, and then probably Honchuan and I will hold a discussion on what we believe are the benefits and the challenges. Bit of a historical thing here, for those who like history. So before Honchuan enters into the detail, and I don't know if you are aware of this, I think I have probably told you this story, which is that the original methods that were created for transfer pricing purposes, they were a creation of IRS in the US. And when transfer pricing was a new discipline, we only had 3 methods, which was the transactional traditional methods. Then I will explain, you will see while we go through the session today, the IRS realized that those methodologies do have some challenges, which we will discuss today. And as a result of that, IRS officers were forced to find a solution to the challenges of the traditional methods or the transactional methods. And that's how the profit methods were born. So I guess our hypothesis today, or what we want to really achieve out of the session, is which one is better? Is it the transactional, or is it the profit, or is it both? So with that, I pass it on to you and hope we can answer that question at the end.
Yep. Yeah, as Adria has mentioned, to add on to that, historically, I think because of that history in mind, where previously OECD would have a hierarchy in place. We have 5 methods here, but then the traditional transactional method were actually preferred as compared to the transactional profit method, right? So now, come 2023, we've evolved from a hierarchy space to actually to be considered the most appropriate transfer pricing methods, right? So we have 5 methods here, and that includes for our Malaysian participants as well. So Malaysia has also evolved from a hierarchical place to more or less the most appropriate method to be selected, right? So we have here the 5 globally accepted methods, which are, the first 3 is actually the traditional transactional method, which is comparable and control price, resale price method, cost plus, and then going down to 4 and 5, which is the transactional profit method, the profit split method, which is one of the focus that we're gonna put on, as well as the transactional net margin method, which is obviously, I think most of the people will know about the transactional net margin method in place. And if you look at all these 5, as Adrian has mentioned, there are pros and cons, strengths and weaknesses that we will be looking into.
Honchuan, and I think 2 key questions here. So how can one decide on whether one method is better than the other? That's question number 1. And question number 2, is these methodologies only relevant for Asia, or is this where is this codified, or is this standard everywhere?
Yep. I'll answer your first question first. So basically, all 5 methods now are equal. The way to select, we have to go through a selection process to come up with the strengths and weaknesses for each method, and then from that phase, then you can understand which methods are to be selected based on the strengths and weaknesses. And your second question in regards to, is it only related to Asia, APAC, US? It's globally accepted, and the only difference is the naming. As you have said, I think in the US, right, for those that have US portfolio, US TP done, where they actually have different terms for these 5. But having said that, the terming, the naming is actually the same, right? So just that the name is different, but the 5 methods in principle are the same.
Okay. And what are other aspects that one has to take into consideration when it comes to methodologies? And I guess at the end of the day, the heart of transfer pricing is about having a tainted or a control price versus independent price. So what is another consideration that one has to take into place when it comes to methodologies?
Yeah, and also to add on that, though we have 5 globally accepted methods, taxpayers can actually come up with other methods to test the unfair nature of your transaction. And the only caveat is that you have to prove that the other methods they are using, apart from the 5, provide the highest comparability level, right? Which is the consideration that we have to make, right? First, we are looking at the strength and weaknesses of each method. Then on top of that, we need to look at the nature of transaction. Is it a simplified transaction, or is it a highly complex transaction where, a hybrid method may be used, for example, but rarely. Then we have to look at, for each method and the transaction itself, the comparability requirements on each, and the degree of comparability of that transaction as well, right? After going through that, then we need to look at whether the availability of data, availability of reliable and relevant data that can be used for the respective methods that you have selected, right? These are the considerations that we need to look at to ensure that during your selection process, you actually select the most appropriate method.
And can you elaborate a little bit more on degree of comparability?
Yeah, so we call it the 5 comparability factors, where, when we look at each method, then we have these 5 comparability factors that we need to take into account for, right? It's not other transactions may have additional comparability factors in place, but these are 5 general ones. Now, the first one is characteristics of the property and service. So meaning to say that, whether the compared element are the same in terms of the property or service as compared to your controlled transaction. Then you'll be looking at the functions performed, the FAR, functions performed, assets employed, and risk assumed in relation to that transaction as compared to your uncontrolled transaction. Then you look into your contractual terms, whether the terms and conditions are the same. Business strategies in relation to that particular transaction. What are the strategies imposed in relation to those transactions? And lastly, you're looking at economic circumstances, where you'll be looking at geographical location, any other sort of means. Some may involve like the political environment of that particular economic environment. So these are the factors that we need to take into account for the purpose of selecting your appropriate transfer pricing methods.
Thank you, Hongchen. So I guess these factors has been also standardized as factors that can affect the price, hence the importance to always have them in mind, regardless of the transfer pricing methodology that is applied.
Mm-hmm.
Now, maybe if you could explain us in a little bit more detail, so why do we have 2 groups of methods? I mean, because one can ask, I guess one question comes into mind, which is like, okay, so why is this relevant? Why is not 5 methods and that's it? Why do we have to group them? What is the relevance of that?
Yeah, I guess it has to do with the historical way of grouping it, right? First up, we have the traditional transactional methods, where it's grouped into your comparable uncontrolled price, resale price, and cost plus, right? So this is where, the traditional methods they're used to actually compare the real transaction against the prices, not just prices, but the margin, the gross margin itself on similar transactions, right? That's where it has all started, and then it has evolved into other appropriate methods, which is the profit methods, right? When we look at profit methods, the real objective of having the profit methods is actually to drill down to the overall net operating profitability of your third party, right, of the taxpayer itself, right? So one point is where they're looking at price and the margin on the gross level, and the transactional profits method where they're looking at the overall net level of the taxpayer, right? Hence, the separation between the traditional and the transactional profit method.
Thank you, Hon-Chun. So maybe let's move on to looking into a little bit more detail the transactional methods and a few examples.
All right, let's look at the traditional transactional method where, okay, CUP, which is comparable uncontrolled price, right? When you look at the name itself, it's comparing the price in relation to uncontrolled transaction, meaning independent transaction, right? So CUP emphasizes on comparing the price itself, the dollar value of the transaction, right? Obviously, there are strengths and weaknesses of these methods itself, where when you look at CUP, we are looking at the price. When looking at price, then one of the weaknesses of CUP is actually where it has very high comparability requirements. You really need to ensure that in order to use CUP, you need to ensure that characteristic, going back to the comparability factors, where we have to make sure that the uncontrolled transaction versus controlled ones, the characteristics is highly similar, or the best is identical, right? So where we're looking at CUP, we have to make sure that they're highly comparable. We're looking at the characteristics as well as the terms and conditions in relation to the CUP, as well as the economic circumstances, the geographical location of that particular transaction, property or service, and only then you can select a CUP. And then going to the other two, right? So resale price is where we're looking at the resale price margin, right? On a gross level, we're looking at the resale price margin to be compared against the resale price margin of uncontrolled transaction, right? So the differences between CUP and resale price is that CUP looks at the price itself, while the resale price looks at the gross margin, the resale price margin, where it is very applicable when we're looking at transactions that do not have any modification or any actual changes to the particular product, for example, where resale price really focus on, in terms of comparability factors, the functions of the transaction itself, right? You can have certain leeways on the characteristics, but then it focuses more on the functions where for resale price, it is applicable for resellers, for example, where they buy and sell and there are no further modification on the product. Then the resale price of margin of this can be used to be compared. And then lastly, we have cost plus, right? Cost plus margin, similar to resale price, we're looking at the gross level as well, whereby we're looking at the markup on cost itself. And when you're looking at cost plus, then we'll be looking at taxpayers that have activities that are cross-driven, right? So these are your manufacturers, your service providers, where then you can actually opt to use the cost plus itself, where each of these will have strengths and weaknesses. And one of the weaknesses, depending on jurisdictions, are when you're using an external level, the caveat is that the recognition in the expenses in different jurisdictions may be different, where certain expenses are parked in your cost of sales, while some other company may have treated that similar expenses into the operating level, right? Hence, there's a disparity between, the resale price margin or cost plus from each company.
Maybe it will be good with a couple of examples, one for each method, so people specifically understand how does each method operate. So you want to first explain the cup?
Yeah, right. So when we're looking at cup, again, we're looking at the price, right? So here we have company A in Singapore selling fertilizer products to company B and company C, right? Indonesia and Malaysia. Now, as I mentioned earlier, cup has a very high comparability requirement, where you'll be looking at first, what are challenges in selecting cup itself. We'll be looking at characteristics of the fertilizer to ensure that both are highly comparable. And in this scenario, let's assume that company C and company A are related parties, and company B is a third-party consumer, where then we could then utilize the product sold, the fertilizer product sold to B, and compare it against C by going through comparability factors and ensure that each factors are correctly assessed and they are highly comparable to make sure that they can be compared against with, right? So this was called internal cup, where we use internal data to compare against with. Now, there are other challenges involved. Let's say that if both company B and company C are related parties of company A, for example, then if there is a lack of internal data, then there will be a very it's a difficult process to ensure that if you want to apply an external cup where to actually search for identical products and also satisfying other comparability factors such as your business terms, business strategies, contractual terms, and economic circumstances, that will be a challenge to ensure that you're using the correct external cup to actually compare against with, right? So when you look at cup, you have to make sure that you have gone through the comparability factors correctly before actually selecting it as your most appropriate method to be compared against.
And I think another point is also the type of product which you mentioned, but for example, fertilizers, there can be many types of fertilizers. So for example, if one fertilizer product is organic and the other one is not organic, is maybe petrochemical based, then that could be a reason for not to work, because the product, even though is the same, if the raw materials are different, then the price is potentially different, and therefore that will have a challenge. Hence the reason why a lot of the times we find very challenging to do cups. How about the resale price, Hon Chun?
Now, drilling down to resale price, the goal of you actually using the resale price is actually to test the resale price margin of the reseller. If you look at this example where we have the supplier selling it to the reseller at 85, then on sell it to the third party at 100, the resale price margin here is like 15%, right? So basically, we're using this 15% to compare it against internal or external data, whether you have similar to what I've mentioned earlier in the cup. You'll be looking at whether you have internal data or external data, right? And as I mentioned, we have to make sure that to use the resale price, we are looking at the functions as a risk to ensure that we are comparing against other similar companies or comparable companies that are performing the same function, right? In terms of product requirement comparability or service product comparability factors, where there can be a leeway to where it's not as the comparability requirements is not as high as cup, for example, where as explained by Adriana earlier, where you have organic versus non-organic. And in terms of resale price, having organic and non-organic will not jeopardize of you actually selecting a resale price, because the function itself, the margin is based on the functions that is performed by a related party, right? Your remuneration of this resale price margin is very much highly dependent on the functions that you perform, right? Where you're buying and selling, and you're earning that resale price in relation to the distribution of reseller activities that you perform. So in terms of selecting comparable companies where you'll be looking more towards the functions itself, which actually put in is more of a high hierarchy than the characteristics of the products that you sell. So as I mentioned earlier, the caveat is that the rationalization of particular expense items in relation to the accounting standards in the particular jurisdictions play a big role as to whether you can actually use an external reseller to be compared against with, because like for example Malaysia, there is no fixed recognition in recognizing certain expenses 100% in COGS versus operating expenses, while as compared to US, for example, all the recognition of expense items are consistent for all companies, right? So you have to take into account the usability of comparable company data in order to use the resale price method externally.
I have a question here. It's a bit of an odd one because we were talking about earlier about profit split and net profit split, right? So let's assume here if my resale margin, not only to the third-party customer as a whole, is 15 or 20%, and we decide between the related parties, which in this case is the supplier and the Malaysian reseller, to split that resale margin. Let's say if it's 15, we decide that one takes 7.5 and the other one takes 7.5. Would that classify as a profit split or as a resale price?
Yeah, that's a very good question, and it's really it confuses clients where, hey, I want to actually have a split of profit between both of my related parties, right? But having said that, theoretically, profit split method involves highly integrated transaction and highly integrated groups where both parties are actually contributing to the something that's not easily valued, right? When we're looking at profit split, then in this case, that wouldn't be applicable. Because when you have two companies that are reselling, and it's not in relation to any IP, it's more about the product itself. And you'll be looking at characterizing each related party to ensure that both are properly characterized and both are properly remunerated based on their characterization of that particular company itself.
Yeah, and I think the other point is, like, you're bringing a very good point, is where it's applicable. But I think the other point is like, profit split is meant to be for net profit, not for gross profit. So we will see another example later that maybe that is splitting just my gross profit is not really a profit split in a strict sense, because you're not taking into consideration all the operating expenses as well. So let's look at cost plus as well.
Yep, I think similar to resale price, we're looking at the margin at gross level, but obviously it's cost-driven activities that we're looking at. And in this scenario, we have a contract manufacturer that produces spare parts and sell it to Compatibility, and it also sell to the related party at cost plus of 42% to its related party in Malaysia. The goal is, again, to test this 42% cost plus margin, right? It, again, similar to what I've mentioned for resale price, right? It can be done for internal and external. And using internal, that's fine. If you have internal data, then we'll be looking at whether the contract manufacturer actually sold to another party, another party or not, or customers, third-party customers that can compare against with this 42%, right? And again, external data, there are caveats involved in relation to what I mentioned earlier on the recognition of, all these external items to ensure that you're comparing apples against apples, margins against correct margins, to make sure that, when you select cost plus, you're actually comparing the same margin, right? So that's the challenge that actually a lot of jurisdictions would have when you're using an external cost plus.
Yeah, and I guess the same rationale applies if I'm dividing the markup that you take two, again, strictly speaking, profit is not a profit split.
Yeah.
Which we will talk about in the following slides as well. So the question is, what are the type of profit methods that we have available? And there is basically two. One, which is the profit split method. And the second one is the transactional net margin method. So both test profit, is just that one profit split, as its name says, is an exercise of splitting profits. Whereas the transactional net margin method is an exercise of testing profits, net profits, with a profit level indicator or a profit value that needs to be selected. Now, the whole idea, even though we don't have hierarchies, is that these profit methods come when it is not practically possible to use the transactional methods, because there is not enough reliable data to derive a reliable conclusion on the arm's length price, because the product or services are unique, such as intangible property, because the traditional methods may not be practical to apply because it can be very complex. So I think, again, this is very important because going down the path of profit methods requires some preliminary requirements. It cannot be used in every single scenario, because even though there is no hierarchy, strictly speaking, the most appropriate method is not necessarily always the profit split. Even though internally it might be an easy way to sort out your internal pricing, but from testing TP might not be the best way to go about it. So basically, the profit split is the exercise of splitting profits or losses in a transaction between the related party entities in a similar manner. So because of that, you end up sharing the risk and reward of the business between the entities that are part of the profit split. And I come back to the point of, generally, when is it appropriate? When there is highly integrated transactions, when the parties, not only one, several, make unique and valuable contributions, when there is existence of unique intangible assets, and my original point, when each party shares assumptions of economical significant risk that cannot be valued separately. Again, it is important to take this into consideration because this can be one of the limitations as to why the profit splits cannot always resolve every single business model. We have two types of profit split methods. One is the residual and the second is the contribution, which basically contribution is kind of, I wouldn't say it's simple, but the idea is to split profits based on value contribution. Residual has a dual exercise of having to separate routine profits and allocate routine profits pairs based on the normal transactional methods, followed by a split of residual profit, which is understood as the entrepreneurial profit, or the profit that needs to be allocated to all the entities in the group that contribute to the intangible and are key entrepreneurs and contribute to the success of the business. Let's see a couple of examples, because theoretically this can be kind of easy to understand, but it is not that easy in our experience to implement. Let's see an example on contribution. We have an asset management company, company A located in Europe, company B located in Singapore, and there has to be some pre-requirements being fulfilled, which is that either the companies are highly integrated and you cannot value the risk and reward separately, or that both contribute to the know-how and entrepreneurial risk of the business. So we summarize it here to make it very simple, but what the contribution profit split tends to achieve, or the ultimate goal, is to first value the contributions or split the functions that contribute to the business. In this case, we have 4 areas, but it can be anything else. Customer sourcing, customer relationship, trading activities, risk monitoring and management supporting activities. Followed by that, we need to value the contribution, and that's where the difficulty comes in place, because that contribution needs to be valued objectively for the methodology to be reliable. And that value is that what comes as an output to allocate a percentage of contribution to company A and B, and it will result on what percentage of profit should go to company A or B. Now, two key things here. Objective contribution, point number 1. Point number 2 is the fact that, for example, in asset management, it's very easy to say, oh, okay, so does it mean that in asset management, usually what you have is that the fees that you receive is a percentage of assets under management. So the question is, if in this example I have 40 to 60, does it mean that the assets under management fees, I just simply split them 40-60? Yes, that can be a starting point, but again, that is revenue. So this is not revenue split. This is not gross profit split. This is not cost plus split. This is profit, and profit means net profit. So that's something to be very mindful of. Then we have the receipt. Sorry?
I actually wanted to throw you something in relation to, well, more so on the profit split, since you have thrown me some questions on my end. Now, based on your experience, I think Singapore is very rampant with asset management industry. Because we are looking at profit split, and we're looking at, that it has to have unique and highly integrated segment. And in your experience, in terms of asset management, how do we define this, highly integrated portion?
That's a good question, because you will have to make an argument that the teams are global and everyone in the team is working to contributing in each of the functions. So you will have to really demonstrate that the second best option, which is, for example, just testing one as a service and the other one as entrepreneur, will derive an unfair result for the entrepreneur versus the routine entity, because they are both bearing the risk of the business. So what I really need to come back to is to say that customer sourcing, customer relationship, trading activities, risk monitoring, and support activities, maybe taking out support activities, they all bear a risk in the business. And that's how I will come about it, that 4 activities have a risk in the business. And that risk is being managed and executing by both company A and B. And because of that, I cannot separate the risk.
Right.
That's how I will go about it. But I get your point. It's quite difficult in the sense that the question from the tax authority will be, well, why don't you just do a, how do you call it? a cost plus, for example.
Oh, yeah.
Exactly. So you could do it for support activities, maybe.
Yeah.
The other point is that the net outcome of a support of a cost plus, which we'll speak in the example, will end up skewing the profit in reality towards one of the companies anyway.
Yeah. And what's your experience in using the contribution analysis? I mean, yeah.
Well, there is reluctancy from the tax authorities, I think. And the reason why they are reluctant is because it's very hard to value the contribution objectively. There is a lot of variables. So for example, if you do it based on expenses, then there is a consideration there associated with the fact that maybe one company is in a country with high expenses, the other company is in a country with low expenses. So that is a point to consider as well, whether it's objective or not. So that's why probably as a sanity check, a lot of the times one end up seeing what's the total profit outcome despite of doing the contribution, to understand if the contribution makes sense after considering all expenses as well.
Yep.
Does that answer your question?
Yes.
But is very, very, very important one, I have to say.
Yep.
And it was not rehearsed. Like the one that I told him also, it was not rehearsed.
I'm just throwing questions at you, so yeah.
I put him on the spot first. So let's talk about the residual profit split, because coming back to your question of having more success, I will say that in theory, this approach has a little bit of more success, because here you isolate the residual profit, you still do an exercise of benchmarking to remunerate the routine contributions, such as contract manufacturer or limited resales or distributor. You allocate a routine profit for these activities, for whoever entities that are performing these activities, and whatever is left is meant to be split between the entities that contribute into the entrepreneur profit. So maybe we should, there is a bit of an oversight here. We need to skip these ones. So maybe let's discuss the transactional net margin method, which is the one that we haven't spoken about, because it's part of the profit methods, but actually the transactional net margin method operationally works very much like the transactional methods, because it involves testing only one entity in the transaction on a net profit level. And that comparison can be done on a single transaction on an aggregated basis, meaning by segment, or on a whole of entity basis. And there has to be a value to test that net profit, which is called a profit level indicator. Probably the most common ones that we come across is operating margin, full cost plus markup, with some other two that are less common, such as return on assets and BERI ratio. So when it comes to transactional net margin method, it's always good to think about, or we always think about distributor services, because it's kind of the type of methodology that is used the most to test distributors or service providers. So in this case, we have a company A, a company B, and company C. And company A is basically a manufacturer of luxury products or beauty products, and sets up distributors in Singapore and Malaysia, company B and company C. So if I was going to use the TNMM, I will have to first explain as to who is the tested party. So I come back to the principles of, is it possible? Is it there is reliable data to do so? And are they not highly integrated? And is there not co-contribution? So I would have to choose the tested party, which in logical sense will be the distributor entities, not the entrepreneur, in this case, company C and company B. And then what I will be testing will be the operating margin, which is basically the return on sales after all costs, including cost of goods sold and operating expenses. Okay, so even though this is a profit method, it works different to the other transactional methods. Now, let's go through an example, but first we ask ChatGPT, what is ChatGPT thoughts on which method is better? And interestingly, that was the reply of ChatGPT. Both, and the good news is that it seems that ChatGPT is not going to replace us, because as you can read, the answer is very theoretical and very OECD. Both profit methods and transactional methods are important tools in transfer pricing analysis, and the choice between them depends on the specifics of the company's circumstances and the nature of the transactions being evaluated. It is not a matter of one being inherently better than the other, but rather about selecting the most appropriate method for the situation. Interesting. So, in theory, I agree with ChatGPT. I think, unfortunately, ChatGPT doesn't have the ability to provide a lot of practical insight, which is why we come up with this example with Hongchuan and myself to elaborate on how one approach it from traditional methods, Hongchuan, me, profit methods, and then we will summarize our comments. So you want to go first?
Sure. I was looking at the ChatGPT response, right? I mean, to a certain extent, theoretically, it's fine. But I think another thing that has been left out is that actually there are certain transactions where only certain methods can be used, right? So you don't need to actually go through, like for example, loan, you don't need to go through a resale price. You don't need to go through a cost plus, right? So there are certain methods that are only specifically for that particular transaction, right? Let's now look at this example, right? So I'm looking at, we have related parties, A, B, C, performing different activities within the group. And, you know, the related party transactions here are like Philippines providing shared services. Then we have C-suites and sales in Singapore. Then Malaysia, you know, service provider, R&D, product and engineering. So, and then their license, the main revenue is actually licensed to the state customers, and other assumption that there are software provider licensing software out. And in terms of going through a traditional transactional methods, then we go through the list, which is, you know, the cost cup, then we have resale price, then we have cost plus. Then first question you need to ask yourself is like, when can I apply any of the three methods? So if I look at this, I've got shared services, I've got R&D, product engineering, C-suites, and sales. Then mostly service provision. Then I'll be looking at, okay, are they reliable? Let's look at shared service. I'm providing outsourced service to Singapore and Malaysia. Then on the service level, I'll be looking at whether I can apply cost plus. Then the challenge is whether I can apply cost plus reliable or not, with the availability of data involved to apply any of the cost plus. If there are any limitation to use cost plus, similarly to R&D, product and engineering. Then in relation to when not to apply, then certain transactions I'll be going through the same three methods again and see whether I could use any of the three methods to not apply these. Then let's look at C-suites, for example. Are there any reliable data for me to actually use any of the three methods to be involved? Right. So then I consider the nature of C-suites, then going through the compatibility factors to ensure that we can use any of the methods involved. So the we have, as I mentioned earlier, we have to go through all these phases to make sure that, you know, when I need to apply, when not to apply. Then I then go to your transactional profit method to see whether it applies. So that is when I pass it to you to see whether, you know, on the transactional profit method wise, are there any applicability of these methods involved in this example
Yeah.
here?
So I think within your methods, we have to bucket in also the TNMM, because your methods, which is the transactional methods, and the TNMM will, in this particular case, will require that one first define what's the IP or the intellectual property. Two, apart from that, who builds or who is the owner or who contributes to the ownership of that IP. And then you could use your transactional methods to remunerate the routine entities in the group, including your cost plus or your resale price or your COP, and potentially a TNMM as well, which is a net profit method. Now, if one cannot identify one entrepreneur, let's say there is two entrepreneurs here and two companies contributing to the IP. If we say that the IP is the software product, then one could argue that it's probably company B and company A, potentially. So once we have to define, there is co-contribution. And the co-contribution of the intellectual property makes it difficult to apply one-side methods. And maybe I could also say that the sales and the business development is also a marketing intangible. Therefore, everyone is contributing to the success of the business. Then I will have to take that argument first to then go down the path of saying, okay, because of that, I'm going to apply a profit split. Or I'm going to apply whether it is contribution or whether it is residual. When can I not do that? Just as a default, when I have one entrepreneur and one owner of the intangible property, and coming to the conclusion that because of regardless, I still have to do a profit split, I think that's where I cannot do that, because I don't tick the boxes of co-contribution of intangibles, highly integration, co-assessment, or risk-reward assumption across the group. Now, one question that we always get asked a lot is, can I change from one methodology to the other or not? Do you have any thoughts on that?
Yeah, I think that's one of the questions where they wanted to change methods to methods every year. I've got clients that were asking that. You should be mindful that when you actually select a method, right, you should actually stick to the method. If there are no changes to any of the transactions, right, you shouldn't be changing methods yearly or in certain periods to your liking, right? When you select a method, it means that you have already selected the most appropriate method at that particular income year, that based on the similar circumstances, with no changes going forward, you shouldn't be changing methods at all.
So I guess the second question is, do we come across industries that use certain approach versus other industries that don't use another approach? I guess my experience is that traditional industries where there is not substantial creation of intangibles tend to follow more doing transactional methods more than profit methods. I think the influx of profit methods have been driven by digital business models where there is a lot of valuable intangible being created. I don't know what has been your experience.
Yeah, I think for industry-wise, we have a lot of we're coming across a lot of these startup companies where, you know, with this digitalized economy and, you know, all these startup unicorn companies where everyone is trying to be in the digital space, that's where the money making is. And, you know, that's where most of these profit methods start. it can be used as a starting process to actually use profit split method, as opposed to your traditional type of industry like manufacturing services. I mean, reseller. I mean, generally you won't actually use profit split methods unless there's specific types of IP. They're actually both. They're two, more than one company that are actually contributing to the unique creation of this intangible.
Yeah. I think the other thing that is also quite challenging is the treatment of profit splits from a tax point of view, because there hasn't been a lot of regulation on how one will treat true ups and true downs that are associated with given or taken profit.
Mm-hmm.
I know this is an issue in some countries such as Indonesia, Vietnam, even Thailand, where there is a lot of challenges around setting up a profit split. You do it in an agreement, but then the consideration for the credit or the debit is profit. So there is an argument to say like, well, because it's profit, is it not more akin to a dividend repatriation more than anything else? So that is something that is on the cards as well, because there is not a lot of regulation on true ups and true downs when they are as a result of a profit split method.
Yeah, I think that's considered a very huge
Uh-huh.
issue when you have that implemented, and during audit, and the tax authorities are not acceptable of this kind of repatriation, then you have a real issue right there.
Yeah, so maybe let's summarize so we can answer some of the questions, some of the points that we discussed. So I guess the key point is that the CUP test the price. So it's the real pure methodology that tested just the price, the specific price in a transaction, and doesn't consider profits, gross profits, nothing. The resale price and the cost plus test the gross profit or the cost plus margin. And that's why when I was telling the story at the beginning of the creation of the IRS, the second batch of methodologies was because they encountered that there was still a lot of profit shifting happening, but it was all driven by operating expenses rather than cost of goods sold. So that's how they came with the profit split and TNMM to test the operating profit, which is very close to the profit before tax, which is the driver for companies to present their tax return. So if we could summarize some of the key points that we discussed, you want to go with your traditional transactional methods?
Yeah. So for traditional transactional methods, including the TNM as well, first, obviously, we will look at when you can apply any of these methods, the nature of transactions, going through reliability of data for each method, availability of the data for each method, and then looking at, as I mentioned just now, some transactions, only certain methods are applicable to those methods, right? Or to those transactions. Like a loan, for example, or a royalty transactions where CUP would be more in line. Is it possible to change methods? It should remain unchanged unless there's substantial changes in your business or transactions. And when there are substantial changes, which means that you actually need to reassess the transaction, right, to maintain the contemporaneous of the TV documentation, for example. And then lastly, you have challenges where, as we had mentioned earlier, CUP may have its own challenges in place, high compatibility requirements. Then we have to look at, the impact for the other party in the particular transaction or related party. And then whether we should be looking at profit outcome as well. And lastly, as Adrian has mentioned just now, the treatment of these true and true downs by respective tax authorities needs to be looked at and reassessed.
Yeah. So in our case for profit splits, when to apply, you need to also consider the nature of the transaction. As you were saying, is not applicable to every transaction, the data available and the reliability. But I think more importantly, the co-contribution of intellectual property, that the business is highly integrated and it is not possible to test a transaction at a transactional level. For certain transactions and business model is not suitable. And I think we spoke earlier, if there is no co-contribution of IP or highly integration, then it is a challenge to argue as to why is the most appropriate method. Similar to the transactional methods, in theory, from governance point of view, you shouldn't be changed from one year to another unless there is a significant change in business. You still need to explain why a particular method was selected and not why the profit method was selected and not the traditional transactional methods. There is a lot of work, I will say, in profit splits when it comes to implement or profit methods on implementation mechanisms, because you will have to do some planning beforehand. I don't think this is something you can implement after your year end. You really need to plan ahead, probably 1 year before you're going to implement it, because you're going to have to run some models and some numbers. And as we said, the treatment of true ups and true downs. Some brief pros and cons. Maybe I start with the profit split. The pros are that it's a group analysis and you can really reach an outcome of fairness, because you will have to do it on a consolidated basis or business segment. It does consider the price and the views of all the parties involved. So therefore, once you achieve it, is one of those methodologies that can be used for all of the countries involved, assuming that the tax authority is okay with it. It shares the risk and rewards. With TNMM, you have that you will do profit testing. It is easier to explain to the tax authorities and easy to administrate. In terms of challenges, I will say that it requires a lot of planning before implementing it. I said earlier, objective allocation keys. Some tax authorities don't understand it and therefore they don't advocate for it. And as subjective as you want to be, sometimes there is some level of subjectivity in it, which is difficult to explain, especially in TP when you don't have benchmarkings. You want to go with yours?
Yep. And with traditional transactional methods, use a objective indicator, the price or margin to be tested. And then, very easy to demonstrate true up, true downs. And tax authorities, they will have full knowledge of using traditional transactional methods. So those are the pros. And the cons is that, it may not consider all parties. I suppose the process play then obviously involve all parties. And then each taxpayers would have to manage their own TP, and as well as the local tax authorities. And you may risk any misalignment in favor of either parties. And then lastly, having a comparable data challenges in some of the methods are one of the challenges for the Resale Price and cost plus, and hence being back to the TNMM for comparable data.
So there is one interesting question, which is, does profit split method applies to loss-making companies?
Yeah, I think, that's a very good question, and it does. It's not just in relation to profit split loss. You can treat as profit/loss split method, right? It applies the same way, same principle, right? Split profit when you're making profit, you still applicable to actually split the losses, right? In relation to what using the method itself, based on the same weightage.
Someone has raised a point, which is like in the case of investment manager and investment advisor working for a fund, will one usually see profit split TNMM cost plus to price the advisory fee? It really depends, because there is here in funds, you have to understand the type of investment management agreement that you have. And this is quite technical, because there is something that is called discretionary versus non-discretionary. And that is the argument to explain whether the company bear risk or doesn't bear risk. Now, whether it's discretionary or non-discretionary doesn't mean that you need to go down to the profit split straight away. You can take risk and use potentially the TNMM, depending on the type of IMA, investment management agreement, that you have. There is one more question, which is, Can you, I don't know what RASI is.
RSC matrix.
Okay. Can we use RASI as an allocation key in measuring the contribution of related party entities when using the profit method? Do you know what RASI is?
Yeah, so the RSC is responsibility accountable. C is I is informed. So basically, it's more towards the functions responsibility, like FAR.
Okay.
RSC may want a part, right? Not the full thing. So you'll be looking at assets employed as well. What kind of assets are being used? On top of that, you also need to look at funding for that particular contribution. What kind of contribution? It's not just RASI, it's not just responsibilities, but more other things as well. Assets employed as well. Any risks being assumed by each entity, right? So these are compiled together to make an informed decision on the weightage of that the split or the weight within the process split method.
Okay. So I think that's pretty much what we have time to cover today, as we already running like 5 minutes. But thank you everyone who participated today in our webinar. You will have our details at the end. Please feel free to subscribe to our YouTube channel. We have 3 or more webinars coming along. Next week, we'll be talking about Singapore and Malaysia, then top tips of TP in Singapore, latest trends of intragroup loans in Malaysia. And keep an eye on it, because once we reach October, we basically will have to take a break of the many webinars we have, and we'll come back at the beginning of 2024. Thank you very much, everyone who participated today, and see you soon.
Thank you.